the Smith School has led the reports, 90 researchers at Oxford in economics, finance, business, and law. So let me take you through the report. What have we done? What did we find? And how did we get there? So our exam questions were, should emerging markets, because of course we're at Oxford, so we think about exam questions, should emerging markets actively push for more climate action? And what are the economic costs of action versus the costs of benefits, or the impacts versus the action on climate change? And how should we seek to accelerate the low carbon transition? And what is new about our approach is that many of the economic models of climate change use some pretty ropey assumptions, I'm afraid to say, that don't give you very plausible results, like optimal warming of 3.5 degrees. And many of the physical scientists that I talk to around the world, including here at Oxford, just laugh at these results. And so what we tried to do here is to take what is increasing scientific detail about the impacts of the climate on the weather, on extreme events, on ecosystems, and how that plays into our economic systems, and use some econometric methods that are pretty new, actually, to take past empirical data. So it's a very empirically data-driven analysis, and then work out from that what we're going to see in the future. Now, the big hesitation we have with our own method is that, if you're looking at the past in order to guide you to the future, and you've got structural breaks in your data, if you guys know this, given the work that you do on the markets, the past isn't necessarily always a good guide. But at least what we've done here is get a very good empirical specification of the past, and the kind of investment warning down there in the fine print. Your investment capital can go up and down is the equivalent there. So that's what's new about what we've done. In terms of the results, we have looked at 3 different scenarios. A scenario with very high ambition that takes us to 1.6 degrees of warming. A current policy scenario. So this is current at the time of writing, which was the early to the middle part of the year, of 2.8 degrees. Now, since then, happily, we've had the net zero commitment from China by 2060, South Korea, the Biden's aiming to get to net zero by 2050. So current policies is now probably below 2.5 degrees, but that's the scenario we're looking at there. And then a worst case scenario where we kind of continue on our merry way, completely oblivious to the damage and the dangers that we're incurring with 4.3 degrees. And the headline results are, you can see there, GDP per capita impact compared to what's called SSP2, the Shared Socioeconomic Pathways 2. It's a kind of UN benchmark, if you like, is that if we have a high ambition scenario, GDP falls by 28%. You compare that to current, it's a fall of 41%, and in a worst case, 45%. Now you see a little star next to the 45% fall. That's because the further out into the future with hotter temperatures you go, the less well specified our model is. So it's likely to be a pretty serious underestimate, that number. But it's what we can do with our methods, which is, I say, a state of the art in a number of ways. To put this really starkly for you, just comparing the GDP impact between high ambition and current, and the impact, very roughly, is around 100 trillion. The difference between those two scenarios, that's in 2020 purchasing power parity terms. Now, these are big numbers, right? So there's a lot at stake here to the economy, let alone as we think about conflict and migration and food shortages and starvation, the rest of it. You can compare that to the transition risk, which we've also calculated. So this is the question of how much of the existing fossil fuel capital stock, coal plants and pipelines and so on, might we have to retire early if we were to be on a high ambition scenario. And you're talking 5 to 17 trillion. There are a number of different estimates here, a number of ways of calculating this, but over the coming couple of decades. So in a sense, there's a rough cost benefit analysis here. We kind of resist that framing, but it gives you a sense of the seriousness and what's at stake. We've got some fairly state-of-the-art estimates here on sea level rise and also biodiversity impact. And if you haven't read the report in detail and you're interested, do jump in and look for more. Now, the other thing we've done in the work is to disaggregate geographically. Of course, it's a report looking specifically at emerging markets. But in order to do that, we've got a country-by-country analysis. And some countries are hit much harder than others. So India, for instance, Brazil too, hit very hard by warming at the kind of 2.5, 2.8 and above levels, because they're already warm climates. And as you increase temperatures further, you exceed the wet bulb, you get to wet bulb temperatures that really make human life and productivity very difficult and low. And it also means that the temperatures don't cool down at night either. So now then raises the big question of how much can we adapt to these kind of extreme heat waves, just extreme temperatures in the economy, and to the other effects of climate change, the flooding, the droughts, and so on. And there's a sense in which we could do more around adaptation in this work. We've done, I think, as much as we were able to do at the time. So, what comes out of this analysis is that it's pretty bad for everybody, but it's particularly bad for some of the emerging market economies. And where that takes you is to the conclusion, well, inaction is just not a viable strategy here. I mean, you can't have a world where, compared to a baseline, you're giving away 60% of your GDP and think, well, it's not really worth doing anything about that. Quite apart from all the other impacts on the natural environment, on other species beyond humans. But the challenges here are very big because we do have enough fossil fuel infrastructure already built to take us over 1.5 degrees. And so, a number of those assets are going to be stranded, and the politics of that can be difficult. But the prize from acting is significant investment opportunity in clean energy assets, and of course these very big numbers of GDP that you save effectively by avoiding the worst climate impact. So that leads us to the question: well, will we take action? And what we're seeing around the world is support from a green recovery from the COVID pandemic is very high, and especially in emerging markets. This is a very positive sign, really, from the citizens of the world, whether it's India, Mexico, China, or Brazil. They're the top of the league here in terms of desire for action. So that then is starting to translate into action by the big players, or at least commitments by the big players. There's a difference there. With the China commitment to net zero, peaking and declining by 2030, it will probably knock 0.2 to 0.3 degrees Celsius off the total warming, just the Chinese step up alone. And you're talking, 1,000% increase in solar, 700% increase in wind, 700% increase in nuclear is the plan coming out of Tsinghua University by 2050. And Biden's plan also is for net zero by 2050, which would lop another 0.1 degree off the warming targets. And with these net zero commitments that we're seeing, you've now got almost 3/4 of the world's GDP covered by countries with a net zero commitment, and almost the same figure in terms of the world's coal consumption covered by net zero targets. So if you're a big coal producing country like the country I hail from, I'm Australian originally, there's a bit of writing on the wall here. I would say it's been on the wall for at least a decade, if not two, but I think my fellow countrymen and women are starting to wake up and think, maybe we'd better start to diversify. It's almost too late. And I would expect further increases in ambition because, of course, we have the big climate summit next year, which is designed for every country to meet together to step up their ambition. And the corporate targets are coming through too. So big miners like BHP have net zero targets. BP, Shell, Mittal all have net zero by 2050 targets at this point. So we're high on ambition. Of course, the question is, will we take action? Now, the reason to think we might take action is that there's an awful lot of money to be made in the process of taking action. We've seen very large renewable energy deployment in the last 10 years, which we anticipated 10 years ago, and of course, much, much more to come. Now, just because there's a lot of something doesn't mean you can make money in it. Some of the renewable players have lost their shirts. So from an investor point of view, it's about working out where the rents in the system are going to come through. But one thing is certain is that as you deploy more renewables, they become cheaper, which means you want to deploy more of them. So you have this kind of positive feedback or amplification in the system that means that this is now effectively a dead search, because the cost, the rate of cost decline, which is continuing, is just unstoppable. Well, that's the optimistic and the good news. And the other nice feature of these feedback effects is that they occur not just within the renewables system, but across batteries, across electric vehicles. So the whole technological ecosystems are now just past, I would say, the tipping point where we start to roll downhill into a much cleaner system. So will we act? Yes, we will. Will it be enough to get us to 1.6 degrees? That's another question. And the other thing we're seeing, if I had you all in front of me in a big room, I'd ask for a show of hands how many of you are vegan or vegetarian. Now, probably not that many, given profile. It'd be interesting to know. But my classroom 5 years ago, almost nobody was. And my classrooms, these are admittedly kind of, international elites at Oxford in their early 20s. But now most of them are vegan or vegetarian. And that sort of shift could have a big impact on emissions. So, right, let me move on. What's the role of finance in the green recovery? Well, the first thing is to note that, as I said earlier, we've already built enough to take us above 1.5 degrees, probably to around 2 degrees. So what we don't want to be doing is financing more fossil infrastructure. It's a stupid idea socially. It's probably fairly risky privately as well. And yet we are still adding it a lot in China, or at least financed by China. And when you look in detail at where these stranded assets are going to be found, there's a good chunk of it in the electricity industry, but it's not just there. There's potential stranded assets in transport as well. And so the kind of key objective of financing and asset management is to make sure you're not caught out with worthless assets. That's kind of a fairly obvious point. Then the next thing in terms of the financial system as a whole is what the public sector can do to help what is often capital sitting in the West to flow into the emerging markets, because the need for the trillions is in emerging markets. The location of those trillions is not always in the emerging markets. It's in the rich economies, kind of fairly obviously. And so one of the things we go through in the report is how governments can put in place fairly creative mechanisms to effectively squeeze out some of the risk to private investors in shifting their capital into this emerging market challenge. In the same way that net zero can happen, it actually will happen, because remember, to stabilize temperatures, it has to happen. And so either it happens because we wipe ourselves out, or we choose to do it. Whether it's going to happen fast enough for us to gain those extra 10/100-ish trillion in the second half of the century per annum will depend on us. The road's going to be bumpy, but this transition is in the interests of emerging markets, and the financial industry has an important role to play. And it's for that reason that I was so excited, actually, when Pictet approached us to say, could you do this kind of analysis for us? And you've been a fantastic partner. So thanks.